Welcome to TheoTrade. This is Don Kaufman. Here we are. It is Halloween Monday, October 31st, 2016. You are watching the Theo Night video. First, this afternoon, we still have about 35 minutes left in the trading day, but one of the reasons I wanted to record this during the live markets is to really display precisely what I'm seeing and what's going on right now in terms of volatility. So the markets, generally speaking, today are massively unchanged. There's not a huge amount going on. Obviously, in the next 35 minutes, hey, things can change. The reason that, again, I wanted to focus specifically on volatility is it's getting bid up. Now, for the most part, when we reference volatility, again, generally speaking, most people think you're talking about the VIX, so why not? We'll start with the VIX. So the VIX is getting bid up today. It's up about 7.5%, neither here nor there. The volatility futures, well, the volatility futures are also on the move. Really, every volatility or volatility-related product is getting bid up today. Now, let me take you a little bit deeper into this. There's really an indication that I look at that is not per se the VIX, but measures the volatility on the VIX. And that happens to be what we term the VVIX. So what is the VVIX? Think of the VVIX, and I'm going to go here to a 9-month. Think of it as, okay, the VIX of the VIX. Now, if that's not confusing enough, just wait. So we're looking here, and the VIX, what is the VIX? Okay, the VIX happens to be 30-day vol of the SPX. That's what the VIX is. It's a 30-day average vol of the SPX. So then what's the VVIX? Well, the VVIX happens to be 30-day vol, okay, of the VIX product itself. Now, what is the VIX product? The VIX product is nothing more than options. And those options on the VIX, okay, and I'll cruise up to the VIX again, the options on the VIX are a tradable product. Now, you can't trade the physical VIX. There is no physical VIX. It's nothing more than a calculation. But the options on the VIX, well, those you can trade. And by being able to look at the options on the VIX, you can get a feel for, are traders coming in there, are they buying volatility or are they selling volatility? And in this particular circumstance, okay, we don't look at the VIX itself. So what? It's up a point. Smart traders today, if they think risk is coming, they'll go in there and they'll gobble up as many volatility, okay, products as they possibly can. In this particular circumstance, today is extremely notable in terms of, hey, we have a day that the S&Ps are generally speaking flat. But the VVIX, which is the volatility, again, of the volatility index, is getting bid higher. That means they're buying volatility, all right? And they have been buying that volatility for days. Now, you know, there's some extenuating circumstances. We have an election coming up, okay? That is why we believe that they're buying volatility at this point. The more they buy volatility, why would they do that? Greater uncertainty around the election. And in this particular circumstance, it's notable when you see volatility being gobbled up, not just here, because you see, what you have to recognize is the VVIX. It's looking at volatility 30 days out on the VIX. So again, I'll go back to the VIX for a moment. I really want to accentuate my point. They're buying volatility back here, some 29 days out. And that's why you see the, November 30th expiration here. And I'll kind of highlight it. There's the November 30th expiration. And it's up to about 103% volatility, which is very close to what the VVIX is. But the one thing that the VVIX does not take into account, neither does the VIX. They're an average of 30-day volatility. What they cannot see is anything less than 9 days. The equation of the VIX and the equation of the VVIX do not incorporate anything with less than 9 days remaining to expiration. Now this people is extraordinary. Volatility, okay, between now and November 9th, clearly includes the election, is up to 161%. What does that mean? Well, have there ever been readings really this high? Let's take a look out at the VVIX. Okay, look at the VVIX for a second and look at some of the current readings. What's some of the highest readings you see on your screen over the last 9 months? We see what? About a 115 reading, and that was, fairly extreme. But let's zoom out a little bit. Let's go back a full 3 years. Now, this happened to be one of the most extreme environments in recorded history in terms of volatility, and that happened to be August 24th, all right, of 2015. It was an August morning. Markets actually went limit down. We saw a 212 print for seconds. Over, roughly speaking, the last 3 years, we have not at any point truly seen volatility getting this bid. And there's only going to be a handful of people that ever recognize this stuff. It's being done very, very quietly in what is a rather docile day in the marketplace. Now, let me further this. So we know that traders are coming in there and they're buying up, okay, volatility hedges in every way, shape, or form. In fact, if you open up the options in the VIX, a couple thousand contracts here, a few thousand contracts there. But, all right, there have been contracts being acquired everywhere. Look at these, again, 15-day options on the VIX. This is where some real damage and size is being traded out there. Look at this thing, 132 volatility. And you see multiple 20,000 contracts trades that have actually gone through today inside of the VIX. So again, very quietly buying up volatility. In addition to it, if you take a look at the volatility futures, now the volatility futures, those happen to be, okay, the underlying for the VIX. That means the volatility futures themselves, this is the product that the VIX options are really priced off of. Again, really convoluted stuff, right? Well, here's something that's not so convoluted. The 16-day volatility futures, compare them now to the 51-day volatility futures. So why should you bother to care about this? Listen, Don, I just got me some of that Apple stock and I just want to worry about that. Yeah, well, when you have 16-day volatility futures pricing almost identically now to the 51-day volatility futures, you start to get a little bit cautious, all right? What this ultimately means is that in the next 16 days, we're seeing almost as much risk as the next 51 days. That's how uncertain the world has become in a matter of like 2 to 3 days over here. At this point, if you're wondering so how does this really resonate with the election? All right, so we know that that's probably the underlying theme of all the risk in here, but how does this really resonate with the election? And the answer is, well, pretty simply put, there's a spread that we've been watching now for a few days, really a few weeks, but I've been explaining it over the last couple of days, and that's the spread in the SPX between the November 7th options, okay, and the November 9th options. Now, just the other day, I was pointing out how this spread was early last week was nothing. This spread was the difference between, okay, the expected move of November 7th and the expected move of November 9th. The difference was $11. Right now, the difference is about, $24. So look, we have a 57 and about anywhere from 33, 34, depending upon how you want to round it. So you're looking at a fairly large expected move differential. In fact, if you look at the volatilities themselves, it almost looks like the S&P 500 has earnings coming out. That's what it's really pricing in. It's like, well, one day the volatility is 13, the next day it's, 20%. It's like the SPX has earnings coming out, and that's really the only way to describe it right now. Again, every volatility indicator that we have is starting to get pegged across the board. It does remind me a little bit of pre-Brexit, We saw something very, very similar coming into Brexit. The only thing to me in this display of volatility being bid up, only thing and the only certainty to me is how uncertain the election happens to be. And whichever side you happen to be on, that's fine. All politics aside, they're pricing in more of a coin flip for this election than you can imagine. And that's why, again, we're seeing such size and such, trade coming in, buying up volatility. Now, in addition to it, the S&Ps themselves are sitting in the most precarious place that they have been in quite some time. So last but definitely not least, what does this really mean for the market? So first of all, it means you should be sitting on pins and needles the next week. This is not a time really for positioning yourself unless you're intimately comfortable with risk. Whether you get bullish or bearish, you got to look at the market right now as a gigantic coin flip. It's a binary decision. Now, again, to compound some of the risk out there, and that's exactly what the markets are doing, to compound some of that risk. This is the last 90 days of trade over 4 hours. Okay, we've only tested into this 2112 region a handful of times, and we're just off it in the S&P futures. We're at 2122. We've dipped down in a couple of sessions. Look at this. Today, even in the overnight session, we dipped down to 2114. 2112 carries with it enormous risks unto itself. So whichever way you want to look at this, yes, we have volatility getting bid up. Yes, we have the market itself in an extremely precarious place. However, you still have to look at this as the election just over a week from now being coin flip decision. I mean, so what do you do in that particular circumstance? Well, you go over to your monitor tab. Now, however big or however small your position happens to be, hey, listen, I make no two ways about it. I'm sitting right now on negative 6,000 spider deltas. I'm beta weighted over here to the spider deltas. Forget about P&L for the day. That's fine. Doesn't matter. You better be asking yourself right now, are you comfortable taking whatever directional risk? You have to beta weight your risk, which means accumulate it. But are you comfortable taking, in this case, 6,000 deltas of risk? I mean, what does that really mean? Well, if I go over to the spiders, right, and that's exactly what I'm going to do. Look at the spiders between now and November 9th. I'll tell you what it means. The spiders are pricing in a $5.66 move. That's their expected range. Could they do something extraordinary? Of course. But at this point in time, let me just round this. I'm taking 6,000 shares worth of spider risk times almost a $6 expected move. The bottom line for me, in the next 9 days, if I'm not willing to wear $36,000 of risk, then I have no business being in this position. And if you cannot answer that question in your own position, you got yourself an issue. This is a time right now for risk mitigation. What do you think the whole professional trading world is doing? Why do you think they're quietly buying up volatility? Because they see nothing coming? No, because they don't want to take that risk. They're not going to be left holding the bag of risk. You likely are. Again, I am, and have no problem saying, I am intimately comfortable with that. If the market goes up, I'm going to take over a $30,000 hit. If the market goes down big, I'm willing to take it. Okay? But that is the design of the position that I happen to be in. Think about your risk over the next couple of days. It's something that we cover a tremendous amount of here at TheoTrade, and it's imperative that you can look at your position, right? Be able to sleep at night knowing the market is displaying a very large binary event. Have a great Halloween and a great afternoon. Thanks everybody for joining us, TheoTrade. Bye-bye.